Welcome to Acera's new employee slash mid-career seminar. In this seminar, we're assuming that you're either new or you're somewhere in your mid-career, hence the name of the seminar. So you're not yet near retirement, which is a good thing because it means that you still have plenty of time to plan for your retirement. So in this seminar, I'm going to tell you all the things that you might want to know about doing that planning. So you're in a really good spot because your retirement is not imminent and you have a lot more time. Okay. Since you're curious enough about retirement planning to watch this, you probably have some questions. Questions like, what do I need to know about my pension? What do I need to do, if anything? Okay. And if I need to do anything, will you tell me what to do? Absolutely. I have organized the answers to those questions in this presentation in the form of a checklist. So we're going to go through this checklist during the presentation, and it will help answer those questions for you and a lot of other questions that you have. The first thing we'll talk about is understanding some retirement basics, and then we'll dive a little bit into pension math. And the reason that we do that is because it really helps you understand on a very deep level, using some basic concepts about how to plan for your future retirement. So it's just really helpful to go through a few of those details. I'll talk about our retirement formula. I'll talk about purchasing service credit. I will also help you get a pension estimate. So I'll show you how to do that for the future. I will help you understand your retirement eligibility when you actually become eligible to retire. I will help you understand additional benefits that Acera offers, like healthcare benefits. We'll talk about designating your beneficiary or beneficiaries for your death benefits. I will talk to you about understanding your career planning options for the future in case you're going to make some career changes. We'll talk about making a retirement planning picture, and we'll talk about starting a 457B account. So we'll talk about a lot of future stuff in this webinar. Now, I know the future can be a little stressful, but we're just going to take it real nice and easy step by step and try to minimize that stress. And then we'll talk about signing up for Acera News. Okay, let's jump right in. First of all, first item on the checklist, understanding retirement basics. So who is Acera? Well, Acera is the Alameda County Employees Retirement Association, okay? And it's made up of a lot of people. So there are about 90 of us that work at Acera, and what we do is we provide retirement, disability, and death benefits to all of our members. So that's all of you. You are members of Acera as well. So you're part of Acera. And you're a member of Acera because of the position that you work in and who you work for. So you work at this point full-time, or at some point in the past, you worked full-time in a retirement eligible position for one of our 6 participating employers: Alameda County, Alameda Health System, Superior Court of California in Alameda County, First 5 Housing Authority of Alameda County, and Livermore Area Recreation and Parks District. So if you work for one of these employers and you work in one of these full-time retirement eligible positions, that automatically makes you an Acera member. As an Acera member, you contribute to Acera's fund every time you get paid. So if you look at your paycheck, and here's an example of a pay stub, you'll look at the before tax deductions column, and you'll see a line in there that says retirement, and maybe it'll say your tier, and we'll talk about tiers in just a minute. And then there will be a dollar amount that comes out of your paycheck. In this case, it's $99 in this example, and it goes into Acera's fund. So you're contributing to the retirement system with every paycheck. And also, your employer is making contributions on your behalf, usually at an equal amount or usually more than you are contributing. So we don't just want that money to sit there and get rusty and get dusty and moldy. We invest it all over the world in a lot of diverse types of investments with the goal of earning interest, which is an additional source of income for the fund. So your employee contributions, the employer's contributions, and the investment earnings combined give us this pool of money that we call Acera's fund. Okay, so what do we do with that money? Well, you, while you work, are earning credit toward retirement. So you're earning your retirement as you work. At some point in the future, you will retire. And at that point, you stop earning retirement and you start collecting retirement. You're going to collect in retirement a monthly allowance for the rest of your life. It's amazing. You cannot outlive your retirement payments. It's going to be every month on the last business day of the month from your retirement date for the rest of your life. So it's a pretty cool benefit that you have access to. Pensions are special. Those contributions that you're paying into the fund throughout your entire career, those employee contributions, because you're participating in a SERA, which is a defined benefit pension plan, okay, the way that it works is everything you've contributed throughout your entire career, once you retire and start collecting those pension payments every month, you're going to get all your contributions back within the first 3 to 5 retired years. Everything after that is like a pure bonus for you. It's really amazing. There's nothing else that works like this. No, 401ks or anything like that, where you have guaranteed income for the rest of your life. So it's a pretty special thing that you get to participate in. Okay. One of the things that will help you understand your membership with the SERA is this chart of pension milestones. Okay, so these are some milestones you'll see along with your membership with the SERA. The first milestone is your date of hire. So that's your first day of work. If you got newly hired directly into a full-time retirement eligible position, this would be your first day that they told you to show up to work. If you started out working in some other capacity, like maybe part-time or something, this would be the first day of your full-time retirement eligible position. Okay, so then for most people, what happens is 2 weeks goes by, and the first day of your second pay period, that is your first day of a SERA membership, also known as your date of entry in a SERA. This is the day when you start earning that credit toward retirement, okay? Now, what happens is, and let me just make a side note here. I think for 2 of our employers, the Housing Authority and Livermore Area Recreation and Parks District, I think I have that right. Your date of entry into a SERA is actually your first day in that retirement eligible position. So there's not a 2-week gap there. But for everyone else, there's a 2-week gap, and then your membership in a SERA starts. Okay, so then 5 years goes by. If you work full-time for 5 years, or if you work part-time, the equivalent of 5 full-time years goes by, and you become vested in the retirement system. Vesting just means guaranteed. So when you're vested in the retirement system, you're guaranteed the vested benefits. You're basically guaranteed the guaranteed benefits that are guaranteed by the retirement system. So that happens at the 5-year mark. There's the next milestone is when you become actually eligible to retire and start collecting your benefits, if you so choose to retire on that date. Now, it's based on some combination of your years of service credit, so how long you've been working, and your age. And I'll show you the different combinations that get you to retirement eligibility during the presentation. But this is the first day that you are physically eligible to retire. So you can retire on that day, or you can keep working and earning more retirement. And so that's why on the pension milestone chart, most people work past their retirement eligibility date to earn more retirement. So that's why there's a gap in between these 2 dates on this pension milestone example chart. Then there's some day in the future, which is your retirement date. And this is a date that you choose. And that happens most of the time. So in most cases. And so it's a date that you plan for. You choose your retirement date and then you retire. There's a few cases where you perhaps become permanently disabled, and then maybe that plan didn't work out. Then you can apply for a disability retirement, but you will still have a retirement date, and that's your first day of retirement. Okay, there's a couple more milestones on here. So after your retirement date is the date that you stop earning retirement and you start collecting it, and you're going to collect it all the way up until your death. And that's when your retirement payments stop. But there are there's different retirement options that you will be told about at the time of your retirement. And most of them will provide the ability to leave a continuance, which is a continuing monthly payment to a beneficiary. And usually it's for the rest of their life. And so that's why Your beneficiary's death is another milestone on here because they can actually get continuing payments after your death. Okay. So that's the first part of pension basics. The second part is just a couple more details about vesting. I said it includes 5 years of service credit. That also includes reciprocal service credit. And I'll talk a little bit about reciprocity in the second half of the presentation, but it's basically when you're linking multiple California retirement systems together in order to kind of get a synergy between the retirement systems. And so if you worked a few years at another retirement system before you came here, and then you work some years, all of the service credits that you earn under those systems combined will get you over that 5-year mark for vesting for all of the systems. So that's why it says including reciprocity. And the guarantee of vesting is by state law. It's the 1937 Act, Employees Retirement Law. And the vested benefits are that monthly retirement allowance for life with the ability to apply for disability retirement if that is warranted. Also, an annual cost of living adjustment in retirement which is a percentage increase to your retirement allowance every year, and then a $1,000 lump sum death benefit. There's other death benefits that are associated with the different retirement options, but that's a basic lump sum death benefit. Okay, one of the major pension basics topics that you need to have a handle on is what tier you're in. So you need to know what tier you're in, and it's pretty easy. It's based on your date of entry into ACERA. So the way to figure out which tier you're in is based on your date of entry. So let me help you figure out which timeline to look at. First of all, if you're a safety member, you're going to be looking at the bottom timeline. Safety members are sheriff's deputies, probation officers, and there may be some other sworn officers in there. Everyone else is considered a general member. So you're going to be looking at the top timeline, unless you're a general member for the Housing Authority or a general member for Livermore Area Recreation and Parks District, and then you'll look at your specific timeline for your employer. Okay, the way this works is if you entered ACERA before each cutoff date in the timeline, that puts you in the tier right before that. So for example, if you entered ACERA before July 1st, 1983, and you're a general member, that would put you in tier 1. If you entered ACERA July 1st, 1983, all the way up to December 31st, 2012, that would put you in tier 2. If you entered ACERA January 1st, 2013 and beyond, that would put you in tier 4. And that's the case for all of the timelines. For safety members, there are a few more tiers here. There's 2 tier 2s, but in this region of the timeline, tier 2C and tier 2D. And which one of those you're in is based on the election that you made within 45 days of starting your safety membership. For the Housing Authority and LARPD, there are some different cutoff dates for the different tiers. So the tier 2 cutoff date, the tier 1 cutoff date is much later. And for LARPD, the tier 1 cutoff date is much later, plus there's a tier 3. So this is how you figure out your tier. Really though, if you really want to be definitive about which tier you're in, the real way to do it is to log into your account on our website, and it will tell you exactly which tier you're in. Okay. And that goes for the safety members if you don't remember which tier 2 you selected. Okay, so at this point, I'm going to show you this slide, and then I'm going to revisit this slide at the end of the presentation, but I just want to establish some context for our discussion here. Okay, so when you go to retire, so you're going to work a career, okay, then you're going to retire with the idea that at that point, you're going to stop earning money from and credit toward retirement. You're going to stop earning money from actively working, and then you're going to start collecting money on the retirement that you've earned in these 3 categories. So you have your ACERA monthly pension, okay, and maybe you have other pensions that would kind of go into this category. So, and then you have Social Security that you've earned. Anything beyond your pension and Social Security regarding the income that you're going to get when you're retired is whatever else you could save and invest. So these are kind of the 3 ways that the 3 sources of income that you're going to see in retirement, and they sometimes known as the 3-legged stool of retirement. These are the things that prop you up and help you live in retirement. What financial planners will say is that in order to maintain your standard of living in your transition between working and retirement, you're going to need in retirement to be, your income needs to be 70 to 80% of what it was when you were working. Okay. Now, at this point, if you're a new employee or if you're in your mid-career, that may sound like a scary number. Like how the heck am I going to earn that much credit toward retirement, or how am I going to save that much? It's actually not very complicated, and you'll see at the end of the presentation when I show you how to get pointed in this direction. So take a deep breath. This stuff stresses me out too, so don't worry. And what we're going to talk about in the first half of the presentation mostly is your ACERA monthly pension, and then I'll touch on Social Security and savings and investments at the end of the presentation. Okay, so that's just some context for discussion. I do see a question on the board. Does reciprocity affect the tier a person's in? It does. So if you have reciprocity with I should say it can, and in most cases it does. So if you have reciprocity where you entered a different retirement system before one of these cutoff dates. So for example, let's say that you started working in Contra Costa County in August of 2012. Well, that's before the cutoff date for tier 4 for ACERA. Okay. And then at some point, let's say, this year you came over and you started working for ACERA and you linked the systems together. Well, we would go by the original date of entry from the two reciprocal systems. So that would put you in tier 2. There's a lot more details about that on our tier page. So if you want to go to acera.org/tier, it will help you figure out, it'll help you parse out what tier you're in if you have an earlier reciprocal work. Also, sometimes if you had a earlier work in an earlier membership with ACERA, that could put you in an earlier tier as well. Okay, so we've covered some pension basics. Let's get into some pension math. When you go to retire, what you will get in your retirement benefit, also known as your retirement allowance, also known as your pension, also known as your pension allowance, these are all synonymous terms for the same concept. What you will get in this monthly retirement payment is a percentage of your highest working salary for each year of service that you earned while you were working. This equation here, which is our retirement formula, is kind of the math version of this sentence. Okay, so let me give you an example and it will help you understand this a little bit better. Let's say that the percentage of your highest salary that you're going to get for each year of service is 2%. And let's say that you work 20 full-time years, so you're in 20 years of service credit. So we'll put that in the formula. That means that your monthly retirement allowance for the rest of your life is going to be 2% of your highest salary for each one of these 20 years. So that means that all we need to do is multiply these two together. 2% times 20 years means you're going to get 40% of your highest salary in retirement. To add some more numbers to it, let's just take an example. Let's say your highest working salary was $5,000. So 40% of $5,000, we multiply them together, is $2,000. So that would become your retirement allowance for the rest of your life. Okay, so it's not actually that complex. The bottom line here is that because it's a multiplication, the higher any of these numbers are in the formula, so the higher your age factor percentage based on an older age that you retire at, the higher your years of service credit because you worked more, and or the higher salary that you end up having during your career means that you will have a higher monthly retirement allowance for the rest of your life. So when I say that you're earning credit toward retirement, you're earning it in these three categories. You're earning it by getting older, before you retire, you're earning it by working longer and earning more years of service credit, and you're earning it by earning higher and higher salaries. And that the higher these numbers are, that gives you a higher retirement allowance. Let me tell you a few details about each one of those three factors in the formula that will help you better understand how to plan for your future retirement. So regarding the age factor percentage, I gave you the example of 2%, but it's probably not going to be 2% for you because there's a bunch of different age factor percentages it could possibly be. So what percentage will it be for you? What percentage of your highest salary will you get for each year of service? Here's a sample age factor chart that we're going to use to figure that out when you go to retire. Okay. So how to navigate this chart is, first of all, you find your tier and you forget about all the other columns. So if you're a general member and you're in tier 2, you would look at just the general tier 2 column or the general tier 4 column for tier 4 members. For safety members, you figure out which column you're in, and then you forget about all the other columns. So you're just looking at this set of age factor percentages. Okay, so the way this works is whatever age you are when you retire, we're going to pull a percentage out of this chart based on that age. So if you are a tier 4 member and you retire at age 60, 1.80% is the percentage of your highest salary that you're going to get for each year of service. That's the number, that percentage that we take out of the chart, put in the formula, multiply it by the other two factors to get your lifetime retirement allowance. And the reason I'm going into so much detail here is basically to explain the concept that these numbers get bigger the older you are when you retire. So you can see that for in every column, the older you are when you retire, the numbers get bigger. Okay, so you get a higher and higher percentage of your highest salary based on your age, the older you are when you retire. There's a maximum age factor percentage you can get for each tier, and that is signified by the blue box for each tier. So if you retire over the maximum age for that tier, like if you're a general tier 2 member and you retire at age 67, well, the maximum age factor percentage is 2.43% at age 65. So if you retire at 66 or 67 or anything over that, you just get the maximum age factor percentage for your tier. So the age factor percentages stop increasing. Another thing I'd like to point out is that they actually increase with every quarter of your birthday. So there's actually a lot more gradations in here. If this and they don't all fit on the slide, so that's why I'm saying this is an example chart. If this were the full chart, this would say like 55, 55 and a quarter, 55 and a half, 55 and 3/4, 56, and so on and so forth. And there'd be a slight incremental increase in the age factor percentage for every 3 months based on your birthday. So if your birthday is January 15th, 1 quarter after your birthday is April 15th. So you go up a notch in the chart, get a slightly higher percentage. The next quarter after your birthday that you wait to retire is July 15th. The next quarter is October 15th, and so on and so forth. So every time you pass one of those dates and don't retire, you go up 1 notch in this chart, and you will get a slightly higher age factor percentage in the formula for you. And if you're enjoying math and you want to see the full set of percentages, you can find that out on our website. That's a lot of detail for new members and mid-career members. So if you don't want to remember any of that detail, the bottom line is the older the retirement age equals a higher age factor percentage up to the max for your tier. Okay. So I talked about the age factor percentage. Let me tell you about how you earn service credit. This is one of the kind of primary examples of how people perceive earning credit toward retirement, because the more you work, you earn more credit. You start earning service credit on your date of entry into ACERA. And you will earn service credit all the way up until your retirement date if you go straight into retirement. Now, some people will stop working and not retire immediately and defer their retirement to a later date. And in that case, you would have a different milestone in here, which would say like work termination or last day of work or something. And then you would stop earning credit toward retirement, and then you become what we call a deferred member, where you're still an ACERA member and you can retire at a later date out of deferred membership. But for the vast majority of people, they will work straight into retirement, and then you're just earning service credit all the way up until your retirement date. So you earn service credit while you work. So during your regular work hours, you're earning service credit. You also earn service credit during all of these types of leave: earned vacation, sick leave, management leave, comp time, holidays, floating holidays. If you earn those types of leave, if and when you earn those types of leave, and you take those leaves you are earning service credit while you're out on that leave. While you're out on that earned vacation, you're earning service credit. So those don't count against you in terms of earning credit toward retirement. Now, there are some types of time when you don't earn service credit, and those are listed out here. You have leave without pay. You have purchased vacation. So that's when your employer will allow you to purchase extra vacation on top of your earned vacation. While you're out on that purchased vacation, you're not earning credit toward retirement. If you sell vacation, so you sell your earned vacation back to your employer for cash, you get cash, but you don't get any credit toward retirement for that. So you don't earn any service credit for that. And then you don't earn service credit for overtime, on-call time, or standby time. Okay, now let me tell you about the concept of purchasing service, because I mentioned earlier that the higher any of those three numbers are in the formula, including the service credit, which is one of the three numbers, the higher your retirement allowance is going to be. So there are some types of time that are eligible for you to purchase to increase your amount of service credit in the formula. That will increase your retirement allowance because it's a multiplication. So it's a good idea, if you have one of these types of time, to go ahead and consider purchasing that service credit, because it will boost your retirement allowance at the time of retirement for the rest of your life. The basic concept here is, all of these types of time are times when you kind of could have earned service credit, but the situation was slightly, I don't want to say askew, but it was like slightly off to where the rules did not allow you to earn service credit during that time. But because that is understood, they have this concept of purchasing service credit so that you can go back and purchase that time later. So first off, you have what is called ineligible or non-covered service, and you can purchase that time. And what is included in this category is part-time work where you started out working part-time for your employer. And I'm not talking about working for an employment agency or a temp agency or under contract. This is just plain old part-time working for your employer. You did not earn service credit for that time because you did not gain a SARA membership until you achieved that full-time retirement eligible position. But you can go back and buy that part-time work once you become a SARA member. Also, the county's temporary assignment pool, which is known as TAP, all of that time is purchasable once you become a SARA member. Also, there's some other designations known as seasonal time, intermittent time, services needed, project work, per diem work, or other, ineligible time with one of Acera's participating employers that's purchasable time. So you can go back and purchase that time. Then there's the days between your date of hire and your date of entry. That's at 2 weeks. That's purchasable. Any unpaid medical leave during your career, where you're going out on unpaid medical leave for your medical condition only, not for family members' medical conditions. Upon returning from that leave, you can purchase all that leave time, up to 1 year of leave time per instance. So if you go out on unpaid medical leave for a year, you come back and work. You go out on unpaid medical leave for another year, come back and work. Whenever you come back and work, both of those 1 year periods are purchasable, or up to 1 year per instance. State disability leave and military leave are similar. You can purchase those upon returning from that leave. Sometimes with state disability leave, there's a workers' comp element. So you're being paid partially by the workers' comp system or the state disability insurance system, and then you're being paid partially by your employer. If that's the case, the part of your paycheck where you're being paid by employer, you are earning partial service credit during that time for that. So that's not purchasable because you've already earned service credit for that. But the other portion of it where you're being paid by the state system, that is purchasable when you have completed that leave. And then if you go out on military leave during membership, when you return from that leave, you can purchase that time. And we also have redeposits. We have 2 redeposits here. Redeposit of a prior membership, which is where you used to be an Acera member in the past and you terminated your employment. And when you did that, you took a refund of your contribution account, all the contributions that you had contributed during your employment. You took a refund. Then you come back to work for one of our participating employers and you become an Acera member again. And you remember back about all the service credits that you earned during that initial membership and you want it back. What you can do is you can put that money back that you had taken out. That's called a redeposit, and you get all your service credit back. There's also redeposits of community property. So this is when you are married or you are in a state registered domestic partnership and you get divorced or you dissolve that domestic partnership. And as part of the divorce or dissolution process, part of your account gets separated out and goes over to your ex-spouse. And what they would get usually is a portion of your service credit along with a part of your contribution account. So they get service credit and they get part of your contributions. Now they can separately retire based on the service credit that is in their account. But if they don't, if they want a refund instead and they take a refund of that money, we will notify you and then we'll let you know that you can pay back that money, the equivalent of that, what they took out. And that's called a redeposit of community property to get that service credit back that was separated out and put into their account. Okay, so that's a redeposit of community property. Finally, we have other prior public service time. This is time that you worked for another public agency in California, for example, a different county or maybe the state under CalPERS or like East Bay MUD or the Port of Oakland, for example. And now you're working for one of our employers and you're an Acera member and you're not eligible for that pension, whatever pension system that that other agency had, you're not eligible for their pension because you have taken a refund of your contributions from that system. Then you can buy that time as Acera service credit. So like, let's say that you worked for 5 years over at the Port of Oakland, and when you left there, you took a refund from the Port of Oakland. You could buy that 5 years as Acera service credit. Here's a different example, similar example. You worked for the Port of Oakland, let's say 4 years, okay? And then you stop working there, but you don't take a refund. And then you come over to Acera, you start working and you want to buy that time. Well, you actually have to refund. You actually have to take a refund from that other pension system for us to allow you to buy that time. Okay, so here are the times that are not eligible for purchase. I'll start with the bottom bullet point. If you are trying to buy that other public service time and you still have contributions on deposit with that other agency, you got to take a refund, like I was just saying, before you can make the purchase. But also, vacation purchase time is never eligible for purchase. Non-medical leave without pay is not eligible for purchase. Contract or temporary agency time, never eligible for purchase. Okay, so let's say that you have one of these types of time, or you may have one in the future and you're wondering how much it will cost to make the purchase. Well, what you're going to have to pay to make that purchase is whatever your employee contributions had been had you worked that time. So for example, let's say that you go out on 3 months of unpaid medical leave, and then you return from that unpaid medical leave. Well, had you been working and had you been getting your paycheck, with each paycheck, some contributions would have come out of the check and gone into Acera's fund. So whatever that amount of money would have been during that 3 months, that's what you're going to have to pay to purchase that time, that 3 months worth of time. Okay. So it's a pretty basic calculation and we do the calculation for you. Now, plus you may have to pay interest depending on how long you wait to make the purchase, because Acera, I said in the beginning of the presentation, whenever you make contributions, we're investing that money. Well, that money is going to be earning interest. Okay. We earn interest most of the time. And it's measured in 6-month periods. So if we earn interest during a 6-month period that ends in June and ends in December, and those dates pass, those interest dates pass at the end of June and the end of December, and you don't make the purchase yet, then you're going to have to pay the interest that your contributions would have earned had it been into the fund. So that's why the longer you wait to purchase service, the more expensive it gets, because you're going to have to pay more and more interest that the money would have earned. Now, how to figure out how much the service credit purchase is actually going to cost, and also how to initiate a service credit purchase is the same process. You simply fill out our purchase redeposit request form. You do that by logging into your account at Acera, and you can fill out that form. What we will do is calculations for you to tell you how much it's going to cost and whether the time is actually purchasable. We'll send you a letter in the mail with the cost. And at that point, you can decide if you want to make the service credit purchase, and also in most cases, how much you want to purchase. Because all of the types of time, except for the redeposits, you could actually purchase a portion of the time if that's only what you can afford. For the redeposits, those are all or none. One more thing I'll say about the cost of purchasing service credit is that for these ones up here, what you're paying is the employee contributions portion. For the other prior public service, you're going to have to pay the employee and the employer contributions portion. And so the other California prior public service purchases cost about triple what these ones cost, just because you're paying the employer's contribution also. You have various payment options. You could pay us in a lump sum from your checking account or savings. That's post-tax, or you could roll over money from a pre-tax retirement account like 401k, 403b, 457, IRA. So you can pay it pre-tax. You could split it up in payroll deductions. We'll do that for you. We'll do all that math for you, and we'll split it up over time. And the basic way that we'll do it is we can split it up on a maximum amount of time of the amount of time that you're trying to buy. So if you're trying to buy like a year's worth of time, we can split up payroll deductions for you over a year's worth of time at the most. Or you can do any combination. So you could, write us a check for some, roll over some money, and then split the rest up through payroll deductions. Okay, I usually get this question, so I'll just go ahead and answer it. Is purchasing service credit worth it, and how do I figure that out? Well, it's actually kind of there's a straightforward way to figure it out for yourself. What you do is you use the benefit estimator tool that we provide for you in your account online. So you go to acera.org/WMS, or you just go to acera.org and press the login button. And that gets you over into your account. It's our member portal called Web Member Services. Okay. In Web Member Services, there's a benefit estimate button or link, and you click on that to use the tool, and you're going to make two estimates. Okay. Estimate one is going to simulate you not making that service credit purchase. Estimate number two will simulate you making the service credit purchase. And we'll see how much that increases your retirement allowance to see whether it's worth it for you. Okay, so for estimate one, in both estimates, you're choosing the same retirement scenario, which is you're choosing the same retirement date. So you plug that in, whatever the date is that you want to get an estimate for. There's a service credit override field, which you leave blank. You don't put anything in there. And then you click submit on the estimate, and it will give you a dollar amount estimate for your monthly retirement allowance for the rest of your life. Then in estimate number two, you choose the same retirement date, so the same retirement scenario, but you will override the service credit number in the service credit override field by the amount that you're trying to purchase. So let's say that in this estimate, it's already telling you that in this scenario, you will have earned 20 years of service credit. And you're trying to figure out what the impact would be of buying 6 months of unpaid medical leave. Well, 6 months is a half a year. So you would take the 20 years that it's already telling you, and you would add 0.5. I may have a screenshot of this. I do. So what you would do is it will project your service credit, and you add whatever amount that you're trying to buy to this number. So in this example, it's 21.27 and change. So if you're trying to buy a year's worth of service credit, or 6 months worth of service credit in the example, you would just add 0.5 to this number and put that in the override field, and then hit get estimate. And that would give you estimate number two. Okay. And estimate number two is going to be bigger than estimate number one because you have more service credit. Okay. So what you do is you just take the difference, you subtract estimate number two from, you subtract estimate number one from estimate number two to see what the monthly difference is in your retirement allowance. Basically, how much purchasing the service credit has increased your monthly retirement allowance. And this increase, this potential increase, would be starting at the time of retirement and for the rest of your life. Okay. Then to figure out whether it's worth it, whether this increase is worth it, what you do is you take the purchase cost that we give you that we send you in the mail on that letter that we send you. We tell you it's going to cost $1,000 or $2,000 or whatever it is to make that service credit purchase. And then you just take this monthly allowance difference and you divide that cost to purchase it by that allowance difference, and that'll tell you how many months it's going to take you to get your money back in retirement through increased retirement allowance. So for example, if we tell you it's going to cost $1,200 to make the service credit purchase, and the difference in your retirement allowance estimates is $100, that's going to take you 12 months to get that money back in retirement. That's actually pretty quick. So in 1 year of retirement, you will get that purchase cost back, and then you'll get to enjoy a higher retirement allowance every month for the rest of your life because you made that service credit purchase. Okay. So basically you kind of do this math for yourself. If it says it's going to take, a year to get the purchase cost back, 2, 3, 4, 5 years, it's probably worth it because you could potentially be retired for, if you retire at age 60 and you live to age 90, that's 30 years of retirement. So you would enjoy a higher retirement allowance based on the service credit purchase for many years. Versus if you do this equation and it says, oh, it's going to take you 15 years, 20 years, 25 years to get the money back, maybe you decide it's not so worth it. So that's how you figure that out. Okay, I talked a little bit about the age factor percentage, a lot about the service credit. Let me tell you a little bit about the highest average monthly salary part of the retirement formula and how ACERA determines that. Because this also helps you, make kind of those final plans for your, final strategy for your retirement. Okay, so what we need to do when we do this, when you go to retire, we need to do this equation for you. So we need to figure out what your highest average monthly salary during your entire career is. So what we do, and what the law tells us that we have to do, is we find the period throughout your career where you were paid the highest. And that is called your final compensation period. Okay, that's our pension terminology for this period of highest pay during your career. If you're in tier 1 or tier 3, it's your highest consecutive 26 biweekly or 12 monthly pay periods, depending on how you're paid. If you're in tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods. So essentially, for tiers 1 and 3, it's your highest year of consecutive pay. For tiers 2 and 4, it's your highest 3 years of consecutive pay. And our goal is to get an highest average monthly salary. So we simply divide the dollar amount that you made during that highest year of pay or highest 3 years of pay by the number of months in that period. And that tells us what your average was over that period. So it's, not that complicated of a calculation. The types of pay that are going to be included are your base pay, of course. And this is all gross pay. So this is all pre-tax pay and before any deductions have been taken out. So your base pay, and then there may be some other pay codes in there that could count toward this. These are also known as footnotes. They're usually based on different skills you have or different education levels. I can't tell you off the top of my head which pay codes are in or out of this equation because there's like 1,000, but you can figure it out for yourself on our pay codes page on our website, acera.org/paycodes. You just pop open the PDF for your employer and it will list out all the pay codes and say yes or no, whether it's in or out of the equation. If you need help finding your pay code on that sheet, ask your payroll manager for more info. And the one that I know is overtime that never counts. For tier 1 and tier 2 members, there are 2 other types of pay that could be included, which is if you sell vacation during that final compensation period, that some of that could be included. Or if you cash out pay, you go straight, your highest period of pay is at the end of your career, and you have vacation left over on the books when you retire. So that gets cashed out by your employer. That some of that pay could be included as salary. That's kind of a complicated topic. If you want to take a deep dive into that topic, I recommend going to acera.org/vacation. And there is a web page on that topic, or you could check out that topic in our pre-retirement seminar, where we talk about that for probably like 30 minutes. At this point, if you're a new employee, or you're in your mid-career, you don't really need to worry about thinking about that. And if you're in tier 4, it doesn't count, so you don't have to worry about it anyway. One more thing that I wanted to say about the final compensation periods is that I mentioned that it's your highest consecutive pay periods, right? But these are full-time pay periods or the equivalent of full-time pay periods. So if you go down to part-time during the time when you're making your highest pay rate, and that time becomes part of your final compensation period, working part-time does not count against you. What we will do is we will find more part-time pay periods to kind of push together to get the equivalent of 78 biweekly full-time pay periods or 26 biweekly full-time pay periods, depending on your tier. So that doesn't count against you. I do want to mention for tier 4 members, there are some benefit limits to your retirement allowance that you're probably going to want to know about. Tier 4 was created when the state reformed pension systems. They passed it's called the Public Employees Pension Reform Act in 2012. It took effect on January 1st, 2013. And they created tier 4 at the state level, and for all the county retirement systems. And there's also this cap on how much salary we are allowed to include for calculating your retirement allowance. The cap is stated as annual earnings. So for example, the cap for 2022 for general members is $134,974. For safety members, it's $161,969. So the way it works is if you earn more money than this in a particular year, whenever you go over that limit, Acera will stop taking out retirement contributions out of your check for the rest of the year. And then when the year starts, it'll kick back in. We'll take retirement contributions. Also, whenever we go to calculate your retirement allowance, we cannot use more annual salary than is in that cap for that year. Now, because you're new employees and mid-career employees, these are the limits for 2022 if you were to retire like right around now in 2022. Now, these numbers go up every year. So by the time you go to retire, these numbers are probably going to be a lot higher. If you want more information about this, we have more information at acera.org/limits. Okay, and just to give you an example, here is the entire equation put together. So you have the age factor percentage. In this example, it's a tier 4 member retiring at age 65 after earning 25 years of service credit. So at age 65 for tier 4, that would be 2.30% from the chart will be their age factor percentage. They earned exactly 25 years of service credit. So 25.0000 years of service credit. I didn't mention it before, but your service credit in the equation is in years, but it's also calculated down to the fraction of a day. So you don't have to get over the next year mark to go up a whole year notch in earning service credit. If you worked for 25 and a half years, it would be 25.5 years. If you worked for 25 years, 6 months, and like half of a day, it would be like 25.5001 or 008 or something. So we calculate it down in the fraction of a day, and you get all that credit in the calculation for you. And then in this example, they were earning $6,000 per month as their highest average monthly salary. And that means that when we multiply these two things, these three factors together, that gives us a monthly retirement allowance of $3,450 per month. Now, in this case, sticking with that concept that I showed you earlier, where we multiply the age factor percentage times the years of service to show what actual percentage of their highest salary they're getting, they are getting 57.5% what we call salary replacement. So their retirement allowance is replacing 57.5% of their working salary. And that's really good. I told you in the beginning of the presentation that one of your targets would be to replace your retirement income replacement should be around the 70 to 80% level. If you were to achieve 57.5% just from the SERA pension alone, that would be, you'd be doing really good, because then you'd have Social Security and to go in there and other savings as well. Okay, so moving on. How do you actually get, now that we've talked about the concepts, how do you do a projection for yourself using your actual numbers to figure out what an estimate of your monthly pension would be in the future? Well, there's a few ways to do this. I'll show you a couple of ways right now. One is to use these salary replacement estimate charts where we've already multiplied out the ages times the age factor percentages times the years of service credit and mapped it all out on the chart. And you find those out on our website. Let me show you let me show you how to do that out on our website. So you would go to acera.org. And you get to the planning page right here, planning your future retirement income, or like I showed you on the slide, you can just type in acera.org/planning. And you simply scroll down. The first, this is a step-by-step procedure on retirement planning. The first step is getting an ACERA estimate, and it actually gives you 4 options. So I'm going to show you these first 2. The first option is to do exactly what I'm telling you right here. Use one of these salary replacement charts. So I'll show you the general member tier 4 salary replacement chart. So you click on the button for your tier. And you think about your retirement scenario, and you think where, and you find the intersection for your retirement scenario. So you think, okay, I'm 40 right now. I'll probably maybe work until I'm 60. That means that I will earn 20 years of service credit in that time. And so you find where those intersect. So you got the column age of retirement is 60. You would go over here for 20 years of service credit. And in that scenario, you would be achieving 36% salary replacement from that, from your SERA pension alone. Now, an interesting feature of the chart is then you can just proceed diagonally for other scenarios. So let's say you want to see what happens if you work another year. Well, you're going to get another year older, and you're going to earn another year of service credit in most cases. And so you just go down diagonally. If you work another year, you would achieve 39.9% salary replacement. If you work another year after that, you would achieve 44% salary replacement. Another year after that, 58 or 48.3% salary replacement. So that's just kind of like how you get a quick ballpark idea of the salary replacement level that you will achieve in the retirement scenario that you are considering. And there's a question up on the board. Let's see. The question is, in the equation where you calculated the retirement for a tier 4 member, you put 6,000 for the salary. Where does the cap of 134,000 play a role? Okay, so you're saying that because 6,000 per month times 12. Okay, so in that scenario, 6,000 per month salary times 12 months is 72,000. So in that case, the cap is 134,000. So you would be nowhere near the cap in that example. To be near that cap, you would have to be, let me see, earning over $11,000 per month. Or to state it another way, $5,100 per pay period. I thought you were calling me out on my math, like I gave an impossible scenario. I'm glad that it was a possible scenario. Okay, so this is how the salary replacement charts work. So that's one way to get kind of a basic ballpark estimate. In order to get a precision estimate, what you would do is log into your account on our website. So you go out to our website, you press the login button. If you've never logged into your account, which means that you haven't created an account, you're going to have to create an account by answering some security questions. But then once you do that, you'll get in here and you'll see this account summary screen. There's a lot of information, pension information about you in here that is really interesting. So I recommend perusing this site. And one of the best reasons to go to and check out your account in here is to make sure everything's correct, because it will tell you which tier you're in, whether you have reciprocity or not, your employment date, date of birth, your entry date into ACERA. So you make sure all that stuff is correct. It'll show you your years of service credit. Make sure that sounds correct. There will be maybe a 4-week lag in the service credit number. So if it's a little off, don't worry about it, because it just takes a while based on the way the system works to upload the data. So don't worry about that. It'll show you your contribution balance. And then what you do is you click on estimate a benefit, and that takes you to the benefit estimate screen. I already showed you a screenshot of this earlier, but the way that you use this is, and let me just zoom in here so you can see it a little bit better. What you're going to do is think of a retirement scenario. You're a new employee, or you're in your mid-career, so maybe you don't have an exact retirement date, but you have kind of an idea of what you want to see. Like maybe I want to see what happens if I retire at age 60, or age 62, or 65, or 67. You can do all of those scenarios. You simply pick a scenario that a set of dates that matches that scenario. If you are thinking about going straight into retirement, what you would do is pick 2 consecutive dates here. So if you're going to work straight into retirement, your separation date would be on one particular day. Your first day of retirement would be on the next day, the day after. So you pick 2 consecutive dates and hit calculate. If you know that you're not going to do that, you're going to terminate your employment and then, defer your retirement to a later date, there might be a separation in these dates. So your separation date would be your last day of work. And what I mean is a gap between these dates. And then maybe you wouldn't retire for maybe 3 years after that. So you put a date in there that kind of matches that scenario. When you hit calculate, it will project an amount of service credit that you will have earned in this scenario. It already knows how much you've earned, because that's in our pension database that your employer transmits to us. And it will do a salary projection for you based on your current salary. It does not project future cost of living increases. So if your retirement is way in the future, you have the opportunity, if you would like, to see what the effect of inflationary cost of living adjustments to your salary would be. So you can override your salary. You just have to do a little math on your own. But if you want a nice conservative estimate, you can just leave that blank. You could also override the service credit number. Like I was saying, if you want to see the effect of purchasing service credit, you can do that. For right now, I would just leave this out of hours of cash vacation compensation blank. That's something more for when you're calculating scenarios in the future, when you're maybe 3 years before retirement and you're in tier 1 or tier 2, for how getting paid for vacation would affect your retirement allowance amount. So again, for a nice conservative estimate, just go ahead and leave this blank. You can put in beneficiary information and you hit get estimate. And this is your retirement benefit estimate. This is going to look a little bit different really soon because we're in the middle of a redesign of this, but it'll have all the same elements. Just to zoom in here, it will show you the different criteria it's using to calculate the benefit. And then down here is your estimated monthly retirement allowance for different retirement options. When you go to retire, there's 5 different retirement options, that you will choose from. For right now, you don't really want to get into necessarily. I mean, you can if you want to read about the retirement options on our website, on our Retire Now page or Ready to Retire page. I think it's sarah.org/retire if you want to. But just to make it nice and easy, just look at this number right here, the unmodified option. This is the one that most people pick. It pays the most of any of the other options. And so this is kind of your basic retirement allowance estimate using the precision estimator. Okay, so that's 2 ways to get a retirement allowance. Okay, let's talk about understanding your retirement eligibility. So the milestone that we're talking about is this milestone right here on the pension milestones chart. This is where the first day that you are actually eligible to retire if you so choose. Okay. Now you can retire on this day, or like I said earlier in the presentation, you can keep working and keep earning more credit toward retirement. For tiers 1, 2, and 3, I'll do tier 4 in just a minute. There are 3 different combinations of age and service credit that will get you to retirement eligibility. Okay, so option number 1, you're at least age 50. So you're age 50 or older. You have at least 5 years of service credit, and you have at least 10 years of membership with ACERA. Now, the difference between the service credit and the membership is simply the membership date, like I said, starts on your date of entry into ACERA. So at least 10 years has to pass from that date. The reason, I don't know why this was written into the law like this. I don't know what the thinking was there, but effectively what it means is that if you worked more than 5 years, let's say you worked 7 years, and you stopped working and you're over age 50, you actually have to wait as a deferred member of ACERA for 3 more years before you're eligible to retire. I don't know why they did that. If you are planning to work straight into retirement, then you just kind of think about it as having 10 years of service credit and being over age 50, and then you can retire because you have the 5 years and the 10 years of membership and you're over age 50. Okay, combination number 2 is that you have 30 years of service credit as a general member or 20 years of service credit as a safety member, and you can actually retire at any age, even if it's younger than age 50. Okay, now option number 3 is where you're over age 70 and you can retire with any amount of service credit, even if it's less than the 5 years of service credit, okay, that you need under option number 1. So those are the 3 ways that you become eligible to retire for tiers 1, 2, and 3. For tier 4, you have 2 different combinations that can get you to retirement eligibility. As a general member, you have to be at least age 52. As a safety member, you have to be at least age 50. And as long as you have at least 5 years of service credit, you can retire. You don't have to do that 10 years of membership thing. Option number 2 is that is the same as the other tiers. You can be at least age 70 and retire with any amount of service credit, even if it's less than the 5 years you needed under option number 1. Okay, so that's how you become eligible to retire. As soon as you're eligible, you can start thinking about retiring. Okay, there's a question. Does service credit in ACERA include other comparable systems you worked in? For example, I have 10 years through Contra Costa County's pension system. Does that count? Okay, so the way reciprocity works is when you link the systems together, you're not combining service credit for the purposes of calculating retirement, but you are combining service credit for the purposes of vesting and for the purposes of retirement eligibility. So that 10 years, so like let's say that you're in tiers 1, 2, or 3, that 10 years at Contra Costa County already gets you over the 10-year mark. So as long as you're age 50 and since you have that 10 years, then you would be eligible to retire under Acera and Contra Costa County. No matter like how much if you've only worked for Acera for a year, that doesn't matter because you 11 years gets you over that 10-year mark. So reciprocity includes all of that. But when we calculate your retirement allowance, okay, so you worked 10 years for Contra Costa County. Let's say that you work 5 years for Acera and then you retire. You have to retire from both systems on the same day. So what we will do is we will each do a separate calculation. Contra Costa will do theirs, Acera will do ours. And in each of our equations, Contra Costa is going to use the 10 years that you earned over there. Acera is going to use the 5 years that you earned here in order to calculate the check that we're going to send you every month. Separately, we will also each put in the age factor percentage, because you might have a different age factor percentage depending on your tier in either system. The salary component of both calculations will be the same, and it will be the highest salary that you earned under any of the systems. And that is one of the major advantages of having reciprocity, is you don't start earning your retirement over from scratch when you go to a new system. Okay, I'm going to tell you very quickly, I only have 2 slides on this about additional benefits that Acera offers, just to get you oriented to the fact that they exist. We won't go into detail because you don't really need to know the details right now, because they're probably going to be different by the time you retire. So we do offer other benefits. We offer medical, dental, vision, and other non-guaranteed benefits in retirement. We also have disability retirement as an option. If you become permanently disabled and you can't perform your job duties, you can apply for disability retirement. And you can actually, if you're permanently disabled, you could go out, if you're eligible, on a regular retirement and then apply for, be collecting your regular retirement while you're in the disability retirement process, which can be a lengthy process. We also have death benefits. There are death benefits, and I think I have some slides on this later, the death benefits actually. So I'll save that discussion for a little bit later. Regarding the healthcare benefits, the only thing I want to tell you about in this moment as a new employee or mid-career employee are the years of Acera service credit you need to qualify for those healthcare benefits, because the healthcare benefits are not guaranteed benefits. The title of the slide is non-guaranteed benefits, also known as non-vested benefits, because they're not guaranteed. These are extra benefits that are offered out of this reserve fund that the county started back in the 80s in order to offer these extra set of benefits to members, to retirees. So the Board of Retirement governs this reserve fund, and what they do is they set what the benefits are, and they monitor the fund every year with an actuary to ensure that the fund stays sustainable into the future. But they're the ones that set the rules on what the benefits are and who gets the benefits, and their rules are based on years of Acera service credit to qualify. So that's the reason I want to show just this aspect of it to you now, is because if you're doing career planning, you may want to consider targeting getting over one of these milestones in order to get this extra money in retirement to pay for healthcare. Because the supplemental cost of living adjustment, which is an extra cost of living adjustment on top of the guaranteed one, that helps you maintain your buying power in retirement. This is the only one of these benefits paid out of this reserve fund that you don't need any years of Acera service credit to qualify. All of the healthcare benefits start at 10 years of Acera service credit. So you can see that there's MMA, stands for monthly medical allowance. That's the name of our medical subsidy. And so at the 10-year mark, you get your access to the medical subsidy, dental, vision subsidy, and a Medicare subsidy. So the reason I'm showing you this to you is maybe you've already earned 9 years of service credit. Maybe you're at 9.5 years and you're thinking about leaving. Maybe you want to stick it out a little bit more. get over that 10-year mark, because between the the half medical subsidy, dental, vision, and Medicare, that's going to represent a lot of extra money to pay for your life in retirement. So that might be something that you target as one of these milestones. Now, if you get over the 15 and 20-year marks, you get more of a medical subsidy. Okay. So that's why I want to show that to you now. And in fact, I'm going to even put an additional milestone on our chart here where the healthcare subsidies start at 10 years. Okay. Now, your retirement eligibility milestone might be before or after this, depending on your situation, but I just need to plug it on there somewhere. Let me tell you, since we're talking about other benefits, let me tell you about death benefits and designating your beneficiary or beneficiaries and keeping them current. A beneficiary, that word just means someone who gets benefits. Now, your ACERA beneficiary is the person you designate to get your ACERA death benefits. Here are what the death benefits are should you die before retirement. So hopefully this doesn't happen, but if that should happen, there are death benefits that will be paid out to your beneficiaries should you die before retirement. Now, I'm not going to cover death benefits after retirement because it's an entirely different set of benefits that is covered in our pre-retirement seminar, and you don't really need to understand it at this point. But should you die before retirement and you're not yet vested, meaning you don't have 5 years of service credit yet, and that includes reciprocal service credit that gets you over the vesting mark. Let's say you're not yet vested. What the death benefits would be is a return of the balance of your contribution account. So it's all the employee contributions you paid into ACERA plus the interest that we paid on that money, because every time the fund earns money, we do pay interest into your account, okay, twice a year. Plus, your beneficiary or beneficiaries would get 1 month of salary for each year of service that you've already earned, up to 6 months worth of salary. So if you've been working for 4 years, they would get 4 months of your salary, for example. Okay, now if you are vested, then there's more options and your beneficiaries get a choice. They get a choice of the option that I just showed you, which is option 1, same thing, return of the balance of your contribution account plus 1 month of salary for each year of service up to 6 months. Or they could choose a monthly survivor's allowance. And what that does is it simulates you being retired on the date of your death. And then they would get paid out. And this is to qualified beneficiaries only, which I think is spouse, state registered domestic partner, minor children. They would get a 60% allowance based on the unmodified option. So it's basically, we calculate what your retirement allowance would have been, and they get 60% of that. For a spouse and state registered domestic partners for the rest of their life. For minor children, there's a cutoff, and there's more details on our death benefits page on that. Option number 3 is a hybrid of options 1 and 2. They would get 1 month of salary for each year of your service up to 6 months. So they get a lump sum payment and then a reduced monthly survivor's allowance. If you die prior to retirement, but you're not actively working, which means you've terminated your employment, but you're still an ACERA member, your retirement contributions are still on in your ACERA account, which means that we call you a deferred member because you stopped working, but you're deferring your retirement to a later date. What your beneficiaries would receive is a return of the balance of your contribution account, so your contributions and interest. There's more details about those at our death benefits page if you go to acera.org/death. I want to emphasize this idea of keeping your beneficiary designations current. You can change as active members and deferred members. You can change your beneficiary designations at any time. So if something happens in your life and you need to update your beneficiaries, all you do is you fill out our beneficiary designation form on our forms page, acera.org/forms. It's a good idea to go ahead and check your beneficiaries today to make sure those people that you designated at some point in the past are correct. Or maybe you didn't designate beneficiaries and you don't remember that. All you do is you log into your account, you click on nominated beneficiary, and you'll see the list of your beneficiaries. There is probably primary beneficiaries and alternate beneficiaries should your primary beneficiary predecease you. If you go to this page and the beneficiaries are wrong, you're going to want to redesignate your beneficiaries. Like if you go here and you see your spouse from 3 spouses ago is your beneficiary, you want to go ahead and redesignate your beneficiary. All you need to do is once you're on this page, click on this link, it'll take you to the beneficiary designations form. Or like I said, you can go to acera.org/forms and find the form. Keep your beneficiary designations current. If you fill out that form today and send it in to us, your beneficiaries will be redesignated as of today. Okay, so let's move into the part of the, there's a couple of major parts here left to the presentation. There's understanding your career planning options, and then there's going to be kind of making a retirement planning map or picture. So let me help you understand first your career planning options. And what I mean by career planning options is whether you are going to stick around in your job and retire from Acera, or maybe you're going to find a different job and work more in that different job and retire from there, and what that means for your pension. So, or maybe you're going to stop working and retire at a later date. So what all your options are regarding that career planning and your pension with Acera. So I'm going to kind of divide this up into 2 categories. Your first option is working straight into retirement. So that's obviously option number 1, is you work your job that you're currently working, or maybe another job for your employer. Maybe you get a promotion, or you change into a different job, and you keep earning retirement, and then you retire from that job straight into Acera retirement. If you do that, and that's what a lot of people do, you're going to earn service credit right up until your retirement date. So you stop earning service credit on your last day of work. If you do that, we will convert your unused sick leave to service credit on a 2-to-1 basis. So you'll basically get half of your unused sick leave as service credit, up to a cap. The cap is in your MOU, but you can check out your MOU on that. You can also go to work somewhere else if you want to. So let's say that you're getting tired of working this job, but you've been eligible to retire for a while, and you feel like you've earned enough here. You can go ahead and retire here, and you could go work like in the private sector or wherever else you want for any other agency, in a different county or whatever you want to do. And we're going to consider you retired, and we're going to pay you that lifetime retirement allowance every month for the rest of your life. And you going to work somewhere else is not going to affect that. So like I said, you can get your Acera retirement at the same time. Let me check the questions here. Is there a time factor? The question is there a time factor you need to be married before retirement for a spouse to receive death benefits? Yes, sort of. There are a set of death benefits that are pretty comprehensive that include a lifetime continuance for your spouse, and you would need to marry your spouse at least 1 year before your retirement date in order to nominate them for that lifetime continuance. Otherwise, if you have not been married for a year before you retire, you can nominate them for lump sum death benefits. So there still could be some kind of minor lump sum death benefits. Or if you were to pass away pretty soon after your retirement, hopefully that doesn't happen, there would be a pretty good chunk of money left in your contribution account to pay out to them. But otherwise, yes, if you want to leave a lifetime continuance to your spouse, you have to marry them at least 1 year before your retirement date. Okay, so we covered the option for career planning of working straight into retirement. Now, kind of the second thing that people might do is, or the other thing that people might do is not do that. You stop working, but don't retire yet, okay? Or don't retire at all from Acera. So I'm going to show you 3 options. I'm going to call them A, B, and C under this option number 2 for what happens if you stop working with Acera, you stop working with your employer, and don't retire with Acera. So we're going to add another milestone to the pension milestones chart for you, because you're not working straight into retirement. You're going to have a termination date before your retirement date. Or perhaps you don't retire from a SERA at all, which is going to be option C, but I'll show you that in just a minute. Okay, option A is you can become a deferred member with a SERA, which means you leave your contributions on deposit with a SERA. You don't take a refund of your contributions when you stop working with your employer. So you're not retiring yet, you're becoming a deferred member with a SERA by leaving your contributions on deposit. And that still means you're an SERA member because the word member is right there in deferred member. You're still an SERA member. As a deferred member with a contribution balance, you have a contribution account, interest will continue to accumulate. And in fact, there's no negative interest. And people ask me what I mean by that. What I mean is if we experience, if there's adverse investment experience, like we lose money in the short term in a SERA's fund, we don't reduce your contribution account ever. Your contribution account only gets bigger because while you're working, you're contributing money and also interest is accumulating. And then if you stop working, interest is going to continue to accumulate as long as the fund continues earning interest. We will keep posting interest to your account twice a year at the end of June and the end of December. There is no other place that you can park your money where there's zero risk. You cannot lose money that earns the kind of percentages that we earn. We earn a little over 7% on average. If you look at our past 30 years of earnings, we earn 7% per year on average, and that includes multiple downturns in the economy. And when I say there's no other place, maybe you can find a place. There's no other place I know of that you can park your money with no risk that earns that kind of percentage. Oh yeah, and there's a question, does the age modifier continue to rise as well? It does, okay? So your age continues to go up and we'll use whatever age you are at the time of retirement, not the time that you stopped working. And you can retire later out of deferred membership. And again, we will use that age at retirement. Or you could come back to work and earn more at some point because being a deferred member is just kind of your membership is on hold. And if you come back, you decide to come back and work for one of SERA's participating employers, then you can do that. And you'll just start, you'll just pick back up kind of where you left off and you'll start earning, you'll start contributing to the fund again and you'll start earning service credit again. Or if you don't want to retire later, you could be refunded at any time. So let's say that you stop working, you decide to leave your money in, interest accumulates. Let's say you leave it in for 5 years, and then later on you decide you want to take a refund. You can do that, and you take all of those interest accumulations with you. Okay, so that's option A, becoming a deferred member with a SERA. Option B is establishing reciprocity with another California retirement system. So I already touched on this a little bit. What this means is that you're linking different public, you're linking a SERA with another public retirement system in California. That includes many cities in California, California state jobs, or any agency in California, which includes many cities that use CalPERS as their retirement system because they're not big enough to have their own retirement system. Most of the counties in California are included. I don't know why I don't have that on the list. I should, because that's a big one. There's a full list. If you go to asera.org/reciprocity, you can see all the different systems. Also, CalSTRS is on the list. I should put that on there. The judges retirement system, not the UC system, that we don't have reciprocity with them. The benefits of establishing reciprocity, I already mentioned this, the service credit that you earn in all of the systems combined is used for vesting and retirement eligibility. So it gets you, we use a combination of all the service credit combined from all the systems to get you over the vesting mark of 5 years and the retirement eligibility mark for your tier. Also, the highest average salary you earn under any of the reciprocal systems is used in all of the systems calculations. I already touched on this as well. We're all going to do separate retirement calculations, and we're all going to call around to the other systems you have linked together to find the highest salary that you earned in any system, and we will all use that in our calculations. If you are not in tier 4, if you're in an earlier tier, it will also mean that you're paying a lower contribution rate than if you had not established reciprocity. because for tiers 1, 2, and 3, your contribution rate is based on your age when you enter a SARA. For tier 4, everyone pays the same rate. In order to qualify for reciprocity, what you need to do is leave your contributions on deposit. So you're essentially becoming a deferred member with every system you're linking together. And I keep saying every system you're linking together. You can do it with more than 2 systems. Like the person who gave the example earlier, they came from Contra Costa and they have reciprocity, and now they're with the SARA. Well, maybe you find a job, a different higher paying job over in San Francisco County. You move over there, work for a few years. Maybe you'll find a different higher paying job down in LA County. You move down there for a couple of years. Maybe you get tired of living in Southern California. You want to move back to the Bay. You come back to a SARA and continue working, under a SARA. So you can link all the systems together as long as you leave your contributions on deposit with any system. Also, no more than 180 days can pass between when you stop your first job, you terminate your first job, your last day of work, and you enter into the next retirement system. So it's about 6 months. You can't have overlapping service. So don't go on like a 5-week vacation to use up your vacation at the end of your work in one job and immediately start another job in that same time frame. That's overlapping service, and that will disqualify you from establishing reciprocity. You don't need to do that because they'll cash you out for your vacation anyway. So you'll get paid for that unused vacation anyway. Also, you have to retire from all of the systems on the same day. So you're going to fill out a retirement application for all those systems, retire from all of them on the same day, and then we'll all do our calculations and we'll all send you separate checks. And when I say separate checks, I mean direct deposits, because it's all direct deposit. Okay, see, I have a question up here. Can you take a lower paying job in another county and that won't affect your highest pay in any other system? Yes, exactly. We're gonna, under benefit number 2, it will be the highest average salary at any time under any of the reciprocal systems. So yeah, if you do take a lower paying job somewhere else, you still have that higher paying job you had with a SARA. Okay. Option number C, option letter C, your third option under not going straight into retirement, is taking a refund of your employee contributions and interest. Okay, so this will go to answer that other question that's up on the board. So you can do this. This is your right. If you stop working, you can take a refund of your contribution account, which is all of your contributions you paid in, your employee contributions only, not the employer contributions. Those always stay with the fund when we're talking about refunds. So it would be the balance of your contribution account, which is employee contributions plus interest. If you do take a refund, it's going to be a lump sum payment and you may lose money to taxes and penalties. Okay, so if you're just looking for cash, we have to withhold taxes and you're going to owe taxes. If you live in California, you will likely owe state taxes. Since you live in the United States, you will owe federal taxes. Also, if you are taking this out younger than there's a age where you get a penalty for early withdrawal from a retirement account. I don't remember what the age was. It might be 59 and a half, but you might need to look that up for yourself. There might be penalties too. And if you combine all those things, it's a third of your money that you lose. Okay. If you want to avoid those taxes and penalties, you simply take a refund and roll that money over into another retirement account. And then you don't owe taxes at that point or penalties. Refunds can take time, 45 to 60 days. There's a plus on there. Could take more than 60 days. So it's not an instantaneous thing if you're looking for instant cash. And you also waive your rights to all the SARA benefits. You're basically saying, I don't want to be in a SARA member anymore. I don't want to have a lifetime retirement allowance. I don't want to have access to those healthcare benefits or death benefits or any of that stuff. I just want a lump sum payment. So it's your right. I happen to think that taking a refund is not a good deal. And that's my personal opinion, because I showed you earlier, I talked about that right off the bat in this presentation. When you do retire from a SARA, if you're actually eligible to retire, you're going to get all of your contribution, the balance of your contribution account back within the first 3 to 5 years through monthly retirement payments from Acera. So essentially, we're taking what we would have refunded you, and we're going to pay it out to you over the first 3 to 5 years in monthly installments. Then after that, you get a lifetime retirement allowance of that same amount plus cost of living adjustments. You get way more money if you retire from Acera than you would have had you taken that refund. And I would say that it's probably super hard to take this money and go invest it somewhere where you get the kind of returns that would match what Acera is going to pay you for the rest of your life. I mean, it's just, you'd have to be really lucky. So unless you're dead set on taking a refund, it's not a great idea in most cases. But yeah, to answer your question, that's how the taxes and penalties work. Okay. Let me pause for just 1 minute, and I'm just gonna duck out for 1 minute. I'll be right back. Okay, thanks for letting me duck out. Not that I gave you a choice. Okay, let's talk about making a retirement planning picture. This is kind of the last big topic we'll talk about. So this is where we're kind of peering into the future a little bit, and we're thinking about years from now, when you're retired, and what your life might look like, and what your income might look like specifically. Because you're working now, you're getting a paycheck. That's how you pay for your life. But when you stop working, you're not going to be getting that paycheck. So you need a way to pay for your life. And that is through these 3 different methods or kind of 3 different sources of retirement income. So you have your Acera monthly pension. Okay. And maybe you have pensions from other counties or other agencies. So I would kind of lump that into this top category here, your pensions. Okay. Then you have Social Security. So if unless you're a safety member who's worked, safety your entire career, you're going to get to collect Social Security at some point in the future. So those are 2 very solid sources of retirement income. Now, anything beyond that is going to be your own personal savings and investments. And what I said earlier is financial planners will tell you that you need 70 to 80% of whatever you were making before retirement while you were working. You need 70 to 80% of that income in retirement in order to maintain your standard of living. So this is a good number to get kind of oriented toward and pointed at this point, being a new employee or employee in your mid-career. So let me take you through this step by step. We already talked about the Acera monthly pension. So let me help you get pointed in this direction and kind of do this equation to kind of, like I said, get pointed in this direction. Okay, step 1 is you are going to get estimates. You want to run some numbers on the future. The first numbers you want to run are your Acera pension estimate and any other pensions that you have. And it's probably a good whenever you sit down to do this, it's a good idea to, get out some scratch paper and kind of keep track of all this stuff. Okay. So you're going to want to get an ACERA estimate, like I showed you how to do earlier in the presentation, by using our calculator online. That estimate is going to tell you, how much you can expect to get per month at a certain age every month for the rest of your life. So you're going to want to write that down on your scratch paper. Then you get a Social Security estimate. Okay. The ACERA estimate is out on our website. You press the login button. I already showed you all these screenshots. You do the estimate of benefit, and you end up with a retirement benefit estimate. Okay. So in this scenario, so you're looking at what you want to look at is age at retirement and what the retirement estimate is for the unmodified option. And you write those down on your piece of paper. So in this scenario, let's say that it's like $2,200 plus at age 62 that you're kind of targeting. You're thinking, what happens if I retire at age 62? Let's see how that maths out. Let's see if I can, get pointed at the income replacement I need by that age. Then you're going to want to get a Social Security estimate. So you go out to the Social Security website, you run their estimator. They're going to ask you to log in. So they're going to have your data in there. You do an estimate, and you're going to end up with something that looks kind of like this, which is where they're showing you for 3 different retirement ages what your monthly Social Security benefit would be. So if you retired at age 62, for example, it's about $1,700 a month. Age 67, $2,500. Age 70, $3,000 a month. Okay, and you can write those on your piece of paper. So in this scenario, you are retiring at an age where you can collect ACERA retirement and Social Security retirement at the same time. But maybe that is not the exact scenario that is going to happen for you. Maybe you need to, wait a little bit on Social Security or wait a little bit on ACERA. And actually, if you're still working, I don't think you can collect Social Security. But you're going to want to think about that as well. But in this scenario, we're just kind of looking at, in this example I'm giving you, we're targeting retiring at age 62 just to see what happens. Okay. So in this scenario, I am going to get $2,200 and change per month from ACERA and $1,700 and change per month from Social Security, retiring at age 62. So what I've done here is I have filled in the first 2 slots on the equation. So then I'm going to use a retirement calculator to figure out how much additional I need to save to get pointed in the 70 to 80% direction. There are a lot of different calculators out online. If you Google them, here's some examples of some that I've used that are pretty good. The best ones will allow you to punch in a pension amount and a Social Security amount, and they will tell you how much additional you have to save, knowing that you already have those other sources of income. And these calculators will all do that. And so I'm going to show you the Vanguard calculator. We'll just use that one. I recommend trying out a few of them because they'll all give you a kind of different number on how much additional you might want to save. And so maybe you can kind of do an average of them to kind of get pointed in the direction of 70 to 80% income replacement. This is a screenshot, but why don't I just go out to the calculator itself and show you how to do it live. So we actually already have links to these calculators on our website. You can go under members and planning your future retirement income. We came to this page earlier, and this is actually a step-by-step process that is a little more detailed of what I'm doing for you here in the webinar. So if you want to follow along on these steps, it will take you through it step by step also. So I'm scrolling down to step 4, calculating how much additional to save now that I know what my pension estimate is and what my Social Security estimate is. So I'm going to go ahead and click on the Vanguard calculator. and use that. Okay, so it's going to ask me a bunch of questions. So I'm going to put in some numbers here in a fictional scenario. Let's say that you are 30 years old currently, and you're thinking, you want to see what happens. You want to see if you can target age 62. Okay, so and you might want to do the pension estimate, the Social Security estimate, and a bunch of different ages, and then you can come back over to this calculator and see, how much more you have to save will actually allow you to retire earlier. Okay, so then you put in your salary, your current salary. Let's say it's 70,000 per year, or whatever it is for you. You can put that in. And then it's going to ask you how much you currently save per year. So if you do already have an amount that you save per year additional in a retirement account, you could plug that in here at this point. I'm going to go ahead and leave it at 0 because I think a lot of people probably have not saved anything at this point, and that's perfectly okay. I would like to show you how, if you've already saved 0, you can start saving, and you can get pointed in that 70 to 80% direction. And so I'm going to leave blank how much I annually save and also how much I've already saved. Okay, so we'll leave both of those at 0. This is asking how much income replacement I'm going to target. So let's target 80%. Let's try that out, because that will give you a little bit more comfortable life in retirement than the 70% will. So we're targeting 80% income replacement. So that's saying that whatever I was making as a working individual, I want to have income that will replace 80% of that in retirement. For this annual return number, this should be a number between, I think, 2 and 7%. This is my personal opinion. 2% is super safe investments. You can park your money in places where there's very little risk and you can earn 2%. These are things like mutual funds that have, there's like some super low risk mutual funds that you can pretty much expect a 2% return. 7% on the top end of the range is investing in a diverse set of investments, kind of like a Sarah does. We kind of expect, that's our expectation, that we're going to earn 7% per year on our investments. And that actually is a somewhat conservative return expectation. So we just want to stay conservative. So I'm going to go even more conservative for this example, and I'm going to go 6%. Okay. Here's the point. So I'm going to click on additional income sources, and here's the point where I plug in what I was going to get from Social Security and my pension. Social Security was about 1,700. I'll just kind of round it off. Sarah was about 2,200. If you have additional pensions, you would want to add those all up and plug the total into this field here. And then you hit calculate, and it's going to show you a chart. What the chart is showing you is how much income you are probably going to need in retirement when you get there per month. What the left column, the left bar, is showing you is how much you will probably have when you get to retirement at age 62 in this scenario, based on your current situation. And this is only considering your pension benefit, which is the top bar, and your Social Security benefit, which is the bottom green, because you had no retirement savings so far that you've plugged in the calculator. Your goal is to make up this gap with retirement savings, okay? So all you need to do is scroll back up and choose a monthly amount, actually an annual amount in this calculator that you're going to save. So let's say that I am going to save $600 per year, which is going to be about a little less than 1% of my annual income. I'm going to come down here and hit recalculate and see how that gets me filling in the gap. Didn't do much. Okay, let's go even more. Let's say 6,000 per year. That would actually be 8.6% of my annual income. Let's go down here and hit recalculate. Okay, that's too much, so I overshot it. So that is actually going to get me more than 80% income replacement, which I'm targeting in this. So I can try reducing it. So let's see what happens if I go down to 4,000 per year. Calculate. There's a little bit of a gap. Let's see what happens if I go to 4,400. Recalculate. Okay, so I'm a little bit over it, but right now I'm at 4,680 that I'll have, and I may need 4,667. Okay, so that means that if I want to get pointed in the direction of 80% income replacement in this scenario, I would want to save $4,400 per year. Now that might sound like a lot of money. Let's see what happens if we divide it by 26 pay periods. It's actually $169 per pay period. Okay. So maybe you can think about whether you can find $169 per pay period in this scenario, or whatever it turns out to be for you when you do this math. Maybe you can't find $169. Maybe you can only find $50. So you just get started with 50. You get pointed in a direction, the direction of retirement savings. And then maybe later, if you get raises or cost of living increases, maybe you can, increase your amount. You do the calculator again and you can increase your amount. Okay. And the question is, that's on the board, would deferred compensation count in this example as personal monthly retirement contributions? Yes. So if you're saving, whatever you're saving per year in your deferred contribution account already, that's what you would want to put in this field here. And it could tell you how much more you would want to increase your contributions to that deferred compensation account annually in order to get pointed in that 80% direction. So yeah, so this is kind of telling you how much money to save, but the question you're asking is kind of where to save your money, and your deferred compensation account is a perfect place to save your money for this. So that's kind of how the calculator works. Let me go back to the presentation. So what I'm illustrating here is one moment in time on this chart. This is one moment in time where you're calculating how much additional you might want to save to get pointed in the direction of 70 to 80% income replacement. So this is how much you've saved, and this is your this is time. Okay. Now what the arrows are illustrating here is you just my idea for this is you just get pointed in a direction. Like I said, if you can't save the whole amount that it's telling you that you would need to save to get pointed in the income replacement direction that you want to, then you save a little bit, as much as you can at this point, and you get pointed in a direction. Then you come back, maybe 6 months later, maybe a year later, do the calculator again. And then it will tell you a different amount that you might want to save. And maybe you can get closer at that point. And then you get pointed in a new direction. Then you come back a year later, do the calculator again. And if you continually do this, if you just readjust this every year or so, or maybe every 6 months, and just check on whether that savings level is appropriate for getting you pointed in the income replacement direction that you're wanting to get to, by the time you get there, you will find that you have achieved your income replacement target. Any particular time that you're doing the calculation, it's giving you a dollar amount. That's not an exact dollar amount that you definitely need to save from now until you retire, because things might change. The situation changes over time. So it's good to periodically recalculate this. Now, regarding the question, since you have an idea of how much money to save, the question is where to save your money. It's a good idea to save your money somewhere that can earn interest. So earning interest is where you're loaning your money out to some other entity with the idea that, like, maybe you're loaning it out to a company in the form of buying their stocks, or you're loaning it out to a government in the form of buying government bonds. And if their endeavors go well, you will earn interest for having loaned out your money to those entities. So they'll pay you a percentage based on how much money you loaned them. And that's basically what interest is. If you put your money somewhere that you can earn interest, what it helps you do is beat inflation, because inflation in the United States on average is about 3% a year. Now, recently it's been in the headlines. It's been way more over the past year, but over the long term, it tends to average out at 3% per year. So if you're not putting your money somewhere that can earn at least 3% interest, then you're losing money to inflation every year. And then it also helps you earn more money over time through the power of compound interest. Compound interest is where you invest some money and you earn a little bit of interest. Okay. And then for the next period, you're leaving your money invested. And now you're not only earning interest on the original money you put in, but on the interest amount that you earned, that dollar amount that you earned. Then the next period, you're earning interest on the original amount plus the interest plus the other interest. And so it compounds. And that's why compound interest graphs, you'll see, will curve over long periods of time upwards, because you earn interest on the interest on the interest that you've already earned. And so that's what people are talking about when they talk about the power of compound interest. So let me help you mitigate risk by just telling you, be cautious. So generally, the higher the potential for risk, or the higher the potential for interest, the higher the risk is going to be involved that you're going to lose money either in the short term or the long term. The most risk is losing money in the short term. The risk of losing money in the long term, if you're putting your investments in something diversified, tends to even out over the long term. But just, be cautious where you're placing your money. So some ways that you can mitigate the risk of investing is by putting your money somewhere that is helping you diversify your investments. It's putting your money in a lot of little baskets. So you're not putting all your eggs in one big basket by like buying an individual stock. You're putting all your money in these little baskets, like these large index funds that invest in hundreds or thousands of stocks. And if you do that, those tend to increase over long periods of time. If you look at the history of the stock market, those tend to increase over long periods of time. So some ways that you can put your money in a place that diversifies your investments and mitigates that risk of putting all your eggs in one basket is in these defined contribution accounts, specifically the 457B account. These other types of accounts, 403B, I think that's for nonprofits. 401k is the private sector. TSP is for federal jobs. You can do IRAs also. That's for anyone, I think. But 457B, because you're government employees, you have access to this type of deferred compensation account. It's called deferred compensation because you are deferring compensation on a pre-tax basis and putting it in this investment account. So when you sign up for the 457B plan, what you're doing, let's say that you're making $3,000 a pay period. Okay. Or let's say it's like $2,000 a pay period, and you put $100 per pay period in the deferred compensation account. That means it's called deferred compensation because you're not getting that $100 right now. You're deferring that compensation to a much later date when you retire. And what it does is it lowers your tax liability, because you will not get taxed on that $100 in this moment. You will only get taxed much later, many years from now, when you take money out of that deferred compensation account. And the power of doing that is, throughout history, tax rates tend to be lower when you're retired because you have less income when you're retired. So you will be taxed at a lower rate. And so that money that you deferred for later, had you not deferred it, you would have been taxed at a higher rate and lost more money now. Whereas later, when you're deferring the tax on that, you're going to pay less. You're going to actually pay less on it. And it will help you earn more money through the power of compound interest over time. Because you're deferring those taxes, you have more money to invest. So it's a really powerful tool that you have at your disposal, the 457B deferred compensation account. For 2022, you can put in a maximum of $20,500 in your deferred compensation account. So you can put a ton of money in that account per year. It would be, it would probably be kind of challenging for a lot of people to actually max that out. You can probably use this if you could use the 457B account alone to do that additional savings and get yourself pointed in that 80% income replacement trajectory. And what happens is when you put your money in the deferred compensation account, you have these different choices of these different index funds that they will put your money in. They will, there's maybe, I don't actually know how many choices, there's maybe between 10 and 20 different choices. And so you could kind of pick and choose yourself where you want to put all your money, but most of us are not investment experts. I'm certainly not an investment expert. I don't claim to know how to do that. And so they have tools in the deferred compensation account that will help you just plug in your situation, details from your situation, and help you target a certain amount of income that you're going to want to have in retirement. And so that's why when I was showing you the different retirement calculators, one of them is the Prudential Retirement Calculator. That's actually the retirement calculator embedded inside your 457B plan account. And so when you get in there, it will actually help you get pointed at that target, and you don't even have to do any of the other calculators if you don't want to. So it's a pretty powerful tool, and so it will help you diversify your investments without you having to be an expert in investments. And the advantage of the 457B plan, in addition to the tax liability, is the fees are really low because you're pooling your money together with all of the other county employees. So that is a multi-billion-dollar fund. That is the deferred compensation fund. And so they get access to investments that you wouldn't get access to if you were just trying to take your retirement savings and go out on your own and try to invest it. So it's a really powerful tool to be able to invest in the 457B plan. I'm trying to tell you everything I know about it because like I emailed you all earlier, our 457B presenter couldn't be with us today at the last minute. So he normally does like a 30-minute presentation. So if you want to view that presentation, you should go to one of our previous months, like February. I sent you out a link to the February presentation, and he will dive into the details of the 457B plan and how you might want to think about starting one of those accounts. I will tell you that starting the account is super easy. You just fill out a form, and the minimum contribution to make that you need to make per pay period is $20. So if you don't want to do any calculations or any projections on the future right now, I think it is just a good idea to get started in the deferred compensation plan by just starting off with $20. You can probably find $20 out of your paycheck to put toward the deferred compensation plan. And just to get started. And that then gives you access to the tools to get in there and do some additional calculations. Okay. Maybe the 457B plan isn't your bag and you want to look at, other savings options to park your money. Or maybe you are one of those people that has the ability to max out your 457B contributions and you want to look at other places you can save additional money. So here's a list of very low risk savings options. These are not medium risk. These are not going to produce high yields. You might be able to make 2% on some of these options, but it's probably going to be less. So here's a list of options that you could do. High yield checking account is basically a regular checking account from a bank that's offering a high interest rate on their checking. A high yield savings account, same thing. It's a regular savings account from a bank that happens to be offering a high savings account. And most of the time they're offering high yields is because they're an online bank that is trying to get new people to join their bank. There's also this thing called money market deposit accounts, where all these first three are FDIC insured. And a money market deposit account is kind of like a high yield savings account, but you can write some checks out of it. But it's very similar. There's also something called a money market mutual fund, which is completely different from a money market deposit account, even though they both have the same name. This is a mutual fund that is one of those low risk funds that it's not FDIC insured, so there maybe is a tiny bit of risk. It's very, very low. And this is one of those funds that you may be able to get close to 2%. But you have to look into that. There's also certificates of deposit, also known as CDs, with a bank. These I don't think these days are paying very high rates. There's also treasury bills and notes backed by the US government. Those are pretty safe, and government bonds, especially US government bonds, are pretty safe. So there's more information about each one of these. There's a description of each one of these out on that planning page out on our website. What I suggest if you're interested in this stuff is these are very easy to research. You type in high yield checking account and NerdWallet in Google, and it will show you what the best checking accounts are currently for this month. You can do the same thing with the high yield savings accounts and money market accounts and CDs. There's also Investopedia, and there's a couple of other ones like that and they just show you who's offering the best deals currently. But just remember, you're solely responsible for any investment risk you take on. If you want more help, since I am not a financial planner or an investment expert, the best thing to do is to spend $20 per pay period, open that deferred compensation account, and that automatically gives you access to free financial planners from the deferred compensation program. And you can meet with them as often as you like. And they do phone appointments. I think they do video appointments. I'm not sure if they've opened up in-person appointments yet. So that's a really powerful tool, and it doesn't cost you anything. That $20 a month you're spending is actually savings because you're paying yourself. If you open an account with the First United Credit Union, which historically has been closely associated with the county and county employees, they also offer free financial planners in a similar fashion. You can hire a financial planner if you like on your own, but it's kind of fraught with people who are charging you high fees. So look very closely at the fees. If you go to a financial planner and they say that they're going to take your money and manage it professionally and pick all your diversified investment portfolio for you, and they're only going to charge you 1% of your annual balance, that is huge. That's a lot of money. That's going to really cut into your ability to earn compound interest over time. So look very closely at whatever fees they're going to charge you. There may be some financial planners that will just charge you hourly for advice. And so that might be the way to go. So like I said, there's an expanded article at acera.org/planning. I'll just show you where to find that one more time. You type in acera.org/planning, or you go under members planning for your future retirement income. And it's kind of a more in-depth step-by-step process of doing what I just kind of walked you through. Getting the estimates, using the calculator to calculate how much to save, determining where you can save your money. Here's those details that I was telling you about the different types of low risk options. There was a discussion of moderate risk options like index funds and robo-advisors. So you can check that out. There is a whole article on how to actually start your deferred compensation account, one with links to the deferred compensation program. and how to make savings easy through payroll deductions, and more about checking your trajectory periodically. And then there's some extra credit items down here. There's some articles about cutting your expenses so you can save more and retire earlier that are pretty powerful. So yeah, that's our planning for retirement page. There's a question up on the board. What do you think about the planners at Empower/deferred comp? Okay, so that's what I'm talking about. Actually, thanks for reminding me of that. The county's deferred compensation program recently changed from Prudential to Empower. I think Empower bought out Prudential or merged with Prudential. And so that's the same program that I'm talking about. So those financial planners are great. And once you sign up for the deferred compensation program, they're free. So they will help guide you to getting that income replacement trajectory that you need in order to have a secure retirement. So I highly recommend that. The last thing is, if you want to keep track of what's going on with Acera over the course of your career, the best way to do it is to go to acera.org/subscribe. So we send out news once in a blue moon. So you're not going to be inundated with news if you subscribe to our news subscription and start a 457B account. And then if you have any more questions at any time, we have a call center that is available during business hours that are out on our website. And their entire job is to answer your questions about your retirement planning and about your pension account. So feel free to give them a call at any time. You can also write to them if you go to acera.org/contact, or you can find that on the contact page on our website. So on behalf of the Acera Board of Retirement and Acera staff, we wish you a fulfilling career and an amazing future retirement that you've earned. And thank you for working for the public. Thank you for working for the residents of Alameda County. Thank you for your public service.